Bonjour.
Bonjour. Régional Pierre-Louis.
Jean.
Régional Pierre-Louis. Régional Pierre-Louis. Enchanté.
En français, c'était ça?
Bonjour, Mélanie Tremblay de l'Institut québécois de planification financière, analyste.
Bonjour, Jenny Provencher, fiscaliste chez Victor, associée chez Oli.
Bonjour, Étienne Dufour, fiscaliste chez Mallotte à Trois-Rivières.
Bonjour, Régional Pierre-Louis, conseiller chez Raymond Chabot depuis un temps.
Bonjour, Cécile Durand, conseiller principal au bureau de Raymond Chabot de Canton de Montréal.
My name is Jean-Vianney Cordero, and my goal is to travel the world.
Mon nom est Jonathan Lee, et mon but, c'est de créer une charité pour une cause importante.
My name is Alexander Barrett, and I too have a goal, to see Céline Dion live in Vegas.
Bonjour, Mr. Robert Légaré. We all have different goals, whether they're small or large, but one thing is true is that they are all important. Today, we are here to help you achieve your goals, and do this in the most tax-efficient way.
How are we going to achieve these goals? We've compiled a list of the most important things that you came to us with. First of all, it's important to understand the current situation which you, Robert, have taken this company to since you took it from the reins of your father, Gilles. We're then going to talk about the company ownership, one of the most pressing issues to you and one of the biggest decisions that you face right now. We're going to talk about one of your most valued employees, Jean Brodeur, and some of the issues going forward with him and how to make him happy. Then we're going to discuss all kinds of nasty surprises that we found in your accounting records, as we promised. So to talk about the current situation, we met you at the Équipe W reunion. We were old friends, and we came to you and we made a promise that we were going to deliver. We made a promise that we were going to go through all of your accounting records, all of your accounting statements, and pull out all those nasty surprises that you were not expecting. We're going to find all those little hidden things that you may not have been aware of, that other tax advisors may not have been providing you the full information with. Now, this company has family spirit. It has teamwork. It has quality. These are the things that built the foundation of your company. And these are some of the most important things going forward. You've experienced tremendous growth since you've taken over the company from your father. And this is so important because you've gotten great contacts in the food industry and you've expanded into superstores across Quebec. So we're going to explore all these issues. So I'm now going to pass it along to one of our fantastic associates, John, who's going to go into one of the most pressing issues, as I mentioned, the company ownership and how you're able to set a plan for your company moving forward.
Well, thank you, Alex. So I'll go forward with the next topic, which is the company ownership. So, as the current situation, you want to transfer your ownership to two key persons. First is Jean Brodeur. The thing is, you find that he is a key employee. He has contributed extraordinarily to the company, and you think that you want him to stay in the company and become a shareholder. The next person is Charlotte, your daughter. She has recently shown interest in becoming a shareholder also in the company and be active in the management. However, she does not have a lot of money in order to buy out the assets or the shares. So, and also she's relatively young, 21 of age. So we've laid out a few alternatives in order to transfer your ownership. The first one is estate freeze. And we'll go forward, explain the second option, which is the stock options, which can motivate your employees to work harder. And the third option is to create a family trust where you can plan for the future for your children. As well, we're going to talk about the sale of shares, which you mentioned to us as an issue. So the stock option program, we think that it is a good alternative since Jean and Charlotte will be eligible to buy out the shares at a lower price when the company does perform better and when the share increases. And this will help them motivate your employees to work harder and to perform better. The next option, we also, going back to this slide, we think that an estate freeze is not an option since essentially what an estate freeze does is it freezes your assets, it brings your value of your company to a lower amount so that it's beneficial for Charlotte, who does not have a lot of money and can come in the company and own a certain amount of shares. However, this option is not beneficial since we want to involve your other children. And currently, with this option, it won't benefit them. So, what we thought of doing is a combination of option 2 and 3. And so the third option is the fiducie, it's to create a family trust called fiducie légale. So setting up a trust and transferring all the shares, the income would be taxed at the trust level at the highest marginal rate of 29%. But this is very beneficial for you since you can plan out for the future, and no matter what happened to you, your children will be there to manage your company and will carry on the legacy for generations. So our proposed solution, as I mentioned before, is a combination of option 2 and 3. So we set up a stock option program and we transfer 70% of the shares to a family trust. So the stock option program will give 50% stock options to Jean as well as Charlotte. And the rest, the 70% ownership will be in the trust and will be evenly allocated to the children. And we did not go forward with the sale of shares since you mentioned to us that you might want to get a loan on your behalf for your daughter, but we do not think that is a good idea since there's the attribution rules. So in the end, the income will be attributed back to you, and essentially what you're doing is selling the shares back to yourself, which is not a good idea. There's a lot of tax issues with that. And can Charlotte get a loan on her own? This is not really feasible since she's only 21. She has little work experience, and therefore it would be very hard for her to get a loan of that size on her own. And next, we're going to talk about Jean. You mentioned to us that you either want to increase his salary since he's a key employee, he's very important in the business, and he has contributed a lot to the company. However, is that really a good idea? Is that really a good option? Will that motivate him to work harder? We think that the best option would be the stock option program, since it is ideal for you. Since for him, he will be. You want him to be. You told us that you wanted him to become a shareholder. So having a stock option program will allow him to own a certain percentage of shares, and this will allow him to. This will motivate him to work harder. And the next topic, going forward with the next topic, is the issue of the car. You mentioned to us that you either want to rent the car or to give him an allowance of $900 per month. Knowing that the monthly lease payments is $550, as well you have to cover the additional payments of repairs of $450, insurance of $825, license and registration of $423, and gas of $3,000. Adding all up, and we calculate also the standby charge of $4,400, and Jean will also be eligible for a reduced standby charge since his business kilometers are over 50% of the overall mileage. So his reduced standby charge would be $2,200, and he will be able to benefit of operating cost benefit of the lower amount of the two amount over here, $1,100. So these amounts will be an income inclusion on his behalf. And so laying out both options, the first one with an allowance of $900, and the second one with the lease payments, we can tell that, that the allowance will be more beneficial for your firm. However, since Jean has expressed his interest to own a car, the Audi, and you really want to satisfy his desire, since you feel that he's a key employee, and you want him to stay, and you want him to lock him down in the company, we do feel that the difference is not that big, and having the lease payments, having you cover the lease payments, will be beneficial for Jean, and this will encourage him to stay with the firm. So I'll pass it on to Jean.
So I see that some of you are drinking coffee, and personally when I get up in the morning, I'm not all there, so I need to drink some coffee to wake up. So I go over to my fridge, I have the coffee, and I go pour the milk, and the last thing I want to do is pour in some spoiled milk. Nobody likes a nasty surprise like that. So that's why we're here today, to avoid that spoiled milk throughout your company and your personal income tax. We want to make sure that we alert you to any nasty surprises that might be coming your way and try to avoid them. So we're going to go item by item and really explain what the nasty surprise might be and the different alternatives to go around getting around these nasty surprises.
Now, Robert, you and I are old friends, and let's just speak man to man here right now. I just want to warn you, it's about to get nasty. So just sit tight, hold on. So we're going to not only talk about tax factors of your firm, but we're going to kind of talk about everything that we noticed. So we just believe in putting everything on the table. As a friend and as a consultant, we want to just alert you of all the problems that we recognize going through your information. So first of all, you have this process with your product development that every single time you want to launch a new product, it kind of has to go through this acceptance process whereby your employees and their families have to accept it. Now, we just want to alert you of this issue because there are pros and cons. So one of the major pros of this is that many different people are testing your product. It can improve the morale and marketing of the firm, just people testing the products, everybody kind of coming together. But there's also some problems here. What are the costs of this? Is this arm's length? And who really makes the final decision about the product? Is it the committee of employees? Is it a president? Is it yourself? So there's just some problems here. We want to make sure that we're really leaning on the product development side rather than on the waste side, and we want to just draw the line somewhere and really just kind of iron this out.
So how do we go about evaluating the company? Well, I think it's fitting that we go all the way back to the beginning and start from there and track our steps one by one. So you can see that your father, Gilles, founded the company in 1979, and it was an initial paid-up capital of $10,000. At that same time, the adjusted cost base was also $10,000, and the legal stated capital, $10,000. Now, moving on, we'll see that there was a transaction that may not have been accounted for, and that's the transfer of land. Now, the ACB of that transfer on Gilles' behalf was $4,500. The fair market value was $45,000. But according to the information given, there was no Section 85 rollover used. So what happens in this case? Well, if a Section 85 rollover was actually done, then essentially what would happen was Gilles would transfer the property, the land, over at the value of the ACB. And in addition, could even take out non-share consideration, or boot, of $4,500 without any tax implications. But what's happening here is because we're not using a Section 85 rollover, the spread between the fair market value and the adjusted cost base on Gilles' behalf is going to be taxed. And this leads to a taxable capital gain of $20,250. And this leads to a ACB on the firm's behalf of $45,000. So we really have to watch out to see if that one is one of the many nasty surprises that might be coming that way.
So your father, Gilles, founded the company back in 1979. And in 2006, you, Robert, finally decided that you were going to take over. I guess it was a family decision from your father and yourself. And he decided to sell you the shares. So back in 1979, he started with an ACB of $10,000. He added land with a fair market value of $45,000. So we've assumed, based on the information that we've received, and we'd also like you to tell us if there's anything else here that we're not seeing, but we've assumed that the ACB here is $55,000 from the information that we have. So basically, when you bought this with this company for $450,000, there's going to be a very large capital gain to report from Gilles. Now, you might be thinking right off the bat that if Gilles has a $197,500 capital gain to pay, you might be paying for his golf membership next year, because that's quite a hefty amount to pay right away. But it's been stated that he's used the capital gains deduction, and we can say that he's used that because this qualifies as a small business corporation, a qualifying small business corporation, QSBC, and this qualifies because of two things. It would have to be 90% active business income, and at least 50% of the business must be taken on in Canada. So because both of those tests were met, Gilles will be able to claim the capital gains deduction against the taxable capital gain of $197,500 in order to kind of wipe that away and shield his loss. So when Gilles sold you the company, he didn't completely step away. He still wanted to kind of be involved, and he took on a different role. He was no longer the owner. He took on a role in which he was a research and development director. So as soon as we see the words research and development, we should be thinking about possible investment tax credits that can come from this. So we've also learned from the documents that you gave us that you've never declared any investment tax credits in the history of the company. So basically what we're saying is that if your father was involved in a research and development role in the past few years, since 2006, you might want to consider what R&D expenditures he had, how this can affect some investment tax credits, whether or not you're eligible for these, and really this can provide great tax savings if in fact you are eligible for these investment tax credits from these R&D expenditures. So this is something that we just want to move forward with you, follow up with, and just make sure that we're all on the same page and following everything here.
So let's talk about the mortgage. This is the personal mortgage from you and Marie for your personal house. Now, one thing that we have to mention here that you might not be taking into account is that the interest on this loan, on this mortgage, is actually deductible. So just taking that into account. Also, we noted that the rate of the mortgage was 5.8%. Now, this mortgage was taken on a few years back. But really right now, we need to look at the interest rates and really evaluate the market interest rate. The Bank of Canada is lending at a rate of 1% to commercial banks with a credit spread of approximately 2%. That means the prime rate for most of the commercial banks across Canada is 3%. Now, we're paying double that, and at an income that you're earning, Robert, of over $150,000, and with the credit history that you have, we believe that you might even be eligible for the prime rate or something around that. If we look at the rates today, we can see that a mortgage, even if you fix a fixed mortgage for even 10 years, you can get a sub 4% mortgage. So looking into potentially refinancing, depending on the risk premium involved, and just looking into the tax implications of that. We also see that you're paying off the actual principal of your mortgage very quickly. You've paid off approximately $80,000 in the last few years. So if you're really trying to avoid paying interest at all, then keep doing that. But just remember, noting that the interest is deductible. So you can keep paying at that rate, and also noting that again the interest rate really depends on how much is left here. So the value of the mortgage depending on the value of the house that's actually the home equity essentially. So if we move on, Alex will discuss the different income inclusions that are required by the children.
So this one is very simple here. You want to teach your kids a lesson. You give them dividends. You give them shares in a company called Banque Royale, which is actually paying dividends every single year of $2. So they each have 2,000 shares, $2 dividends each share per year. They have income inclusions. This is referred to as the kiddie tax, and is taxed at the highest marginal rate in the hands of the children. So this is just something that you should be aware of. It's a great idea to teach your kids a lesson, just giving you the tax implications. So you have a rental property that you co-own with your wife, Marie, and you have rental income of $39,820 last year, and you've made some deductions for maintenance. So you've had some windows that were broken that you had to fix, and some minor maintenance. All maintenance is deductible on a rental property since it's used for business. We've got insurance, property taxes. We've got travel fees, which unfortunately you're not going to be able to deduct for a rental property since it doesn't qualify. Capital cost allowance, you've been using at 4%. Since this property was acquired very recently, it's going to qualify for the 6% capital cost allowance, so you can actually deduct a little bit more than you were deducting. So the offset with the travel fees and the capital cost allowance, you're actually having less taxable income on the rental property after we've kind of gone through the numbers there.
So we're just going to talk quickly about your passion for wine. In the interest of time, I'm just going to mention that this could be a listed personal property, and the fact that there are floor rules to consider in terms of capital gains, a minimum of $1,000. So let's say you sell your wine for $1,200 in the future, the minimum floor was $1,000, so it's a $200 spread on your capital gains. Same thing applies for capital losses, but in the interest of time, we're going to move on. If you have any questions about that, we can feel free to ask them in the question and answer period, and we'll cover that later. In terms of a dividend in kind, we believe the purification of your company, just to improve that percentage, really just giving out a dividend in kind for the temporary investments, which is close to $500,000. It not only improves your asset turnover ratio, but improves your QSBC ratio because generally a temporary investment is not, would not help your QSBC ratio because it's investments generally in a corporation. We look at the balance sheet, we investigate. There are different items here. The real thing to note here is that the debt has really doubled, and we need to investigate why. There was not enough information given. Basically, this expansion would be the explanation, but we need to understand a little bit more. So we're going to discuss together and potentially bring in an auditor from Raymond Chabot or Manette or Richter and really try to get them to help us investigate this.
So we've got meals and entertainment that we're deducting. We've got some season tickets to some sporting events. So first of all, just to let you know, we're going to deduct the Christmas dinner fully. And your starting amount was $13,850. So we're just going to use that as the starting amount and deduct from there. So we're going to deduct half of your meals, half of your entertainment, and fully deduct the Christmas dinner.
So again, in the interest of time, we're going to just go ahead and move on to the conclusion. And really, if there are any questions on these other slides, just please feel free to bring them back. What's really important here is the difference between a goal and a dream is having a deadline. And we're here to help you achieve your goal.
On est maintenant ouvert à une période de questions.
Oui, j'ai des questions. Pour la recherche et développement, vous avez parlé d'un crédit, tant mieux, je n'étais pas au courant. Est-ce qu'il y a quelque chose que je peux faire? Moi, j'ai jamais vu ça dans le passé. Là, on le voit là. Est-ce que c'est pour le futur? Qu'est-ce que je peux faire pour ça?
What can she do for the research?
I can speak English too.
Oh, sorry.
It's okay. You can speak whatever you're comfortable with. So we're just saying that you should be aware of these moving forward. So we're not going to retrospectively go back 7 years and start looking at all these research and development costs. We're just going to look at the past few years, see what kind of costs we have, see what we're dealing with, all these R&D expenditures, and we're just going to see basically what the company right now is spending on this, and we're going to see whether or not we're eligible for these R&D expenditures. Again, we need a lot more information on the company in order to do this. So we want to move forward, and we want to make sure that we're claiming all the tax credits that we can. So all the personal tax credits, all the corporate tax credits that we can claim in this company, we want to make sure that we're claiming them. So it's really just to take the past as a sample to use it and to move forward and to start claiming the maximum that we can use.
But let's say we are eligible. Is it only for the future? Can I do anything else?
Well, from our understanding right now is he's been working since 2006. So we're not going to move back as far as 2006. Perhaps in the last few years we can reprimand the tax returns for the past 2 or 3 years, I believe, and we can kind of go back and reprimand those tax returns. As far as going back into the future, we're not even sure how long this has been going on. Has it been going on before Gilles stepped down and went into an R&D role? Has been going on since he started the company in 1979. What we're recommending really, as our firm, we're recommending to go back maybe 2 or 3 years to look at that, try and reprimand the past tax returns, claim our personal tax credits that we're eligible for, let's say in the past 3 years, and then always do that moving forward.
But tell me.
J'aurais peut-être une petite question à propos de la planification proposée avec la fiducie. Quand vous parlez de transférer 70% des actions à la fiducie, je me demande comment vous comptez procéder là, pour faire ça.
Pour faire le transfert de la fiducie du shares, we're thinking of rolling over the shares to the trust with using the election of 85, section 85. Yeah.
I have a little question about the rental income. I bought the property all by myself, but the rental income, well, I'm splitting it with Marie. can I have any problem there? Because like the rental income, like the net revenue,
Yeah.
I'm splitting it 50-50 with Mary, but I paid all the property. So Mary didn't do anything in it, she doesn't work in it, so she's just getting income, but I paid for all of it. So do you think that there could be any problem there, or I can continue this point, or?
Well, basically, so what you're saying here is that you've paid for the full house yourself, and that you're trying to split the income with Marie. We just really need to investigate that a little bit further. If there are attribution rules that we need to worry about, based on our interviews, we were under the assumption that this was a shared purchase, so we need to reevaluate if it is purchased by yourself, Robert, and there's some income splitting here going on. We got to watch out about attribution rules from Marie back to yourself, Robert, because it could end up being an inclusion on your part.
All right.
Just to add on to that, like Marie is not working at the moment, and she has very little income. The rental income is her only income right now. So as Jean just mentioned, perhaps we weren't aware that it was jointly, that it was solely bought by you. We were under the impression that both of you had put into this at some point. Perhaps, yeah.
I have.
You said you can CC on the rented the property at 6%. I was wondering why, because it's a residential property, you know? Why can you claim the higher 6%?
Well, in class 1, where you're claiming the buildings, you've got three different rates that you can be claiming. So you've got the 4% rate, which is the standard rate,
Yeah.
and then if it's a property that was acquired in the last several years, you're able to claim an extra 2%, and then if it meets then there's another test where if it's 90% manufacturing and processing, you're able to claim an even higher percentage. So it does not meet the test of the manufacturing and processing percentage, but it meets the
Okay,
middle.
Okay. I was not, because it seems property.
Merci. Thank you. Merci. Thank you. Bon, c'est good.